Choosing the best ETFs for your portfolio is not a one-size-fits-all process. You need to consider several factors, such as your investment objectives, your risk tolerance, your asset allocation and your preferences for different types of ETFs. In this section, we will guide you through some steps to help you narrow down your options and pick the right ETFs for your situation. The first step is to identify your goals. What are you investing for? How long do you plan to hold your investments? How much money do you need to achieve your goals? These questions will help you determine your time horizon, which is the length of time you expect to keep your money invested. Your time horizon will affect how much risk you can afford to take and how much growth you need from your investments. Generally speaking, the longer your time horizon, the more risk you can tolerate and the more aggressive you can be with your investments. This means you can allocate more of your portfolio to stock ETFs, which have higher potential returns but also higher volatility. On the other hand, if you have a shorter time horizon, you may want to be more conservative and allocate more of your portfolio to bond ETFs, which have lower returns but also lower volatility and provide income. The second step is to gauge your risk tolerance. This is your ability and willingness to handle fluctuations in the value of your investments. Risk tolerance depends on factors such as your age, income, expenses, savings, personality, and emotions. You need to be honest with yourself about how much risk you can handle without losing sleep or panicking. Generally speaking, the higher your risk tolerance, the more aggressive you can be with your investments. This means you can allocate more of your portfolio to stock ETFs that track specific sectors, regions, or themes that may have higher growth potential but also higher uncertainty. On the other hand, if you have a lower risk tolerance, you may want to be more conservative and allocate more of your portfolio to stock ETFs that track broad market indexes that offer diversification and stability. The third step is to determine your asset mix. This is the percentage of your portfolio that you allocate to different asset classes, such as stocks, bonds, and cash. Your asset mix should reflect your goals, time horizon, and risk tolerance. It should also be diversified across different sectors, regions, and styles to reduce your exposure to any single source of risk. There are no hard and fast rules for choosing an optimal asset mix. However, a common rule of thumb is to subtract your age from 110 and use that number as the percentage of stocks in your portfolio. For example, if you are 30 years old, you could allocate 80% of your portfolio to stocks and 20% to bonds. Of course, this is just a guideline and you should adjust it according to your personal situation and preferences. The fourth step is to select types of ETFs. There are many types of ETFs that can expose your portfolio to different assets and markets. These include stock ETFs. These are ETFs that track indexes or baskets of stocks. They can be classified by market capitalization, large cap, mid cap or small cap, investing style, value, growth or blend, sector, technology, healthcare or energy, region, US, international or emerging markets, or theme, environmental, social or governance. Bond ETFs. These are ETFs that track indexes or baskets of bonds. They can be classified by issuer, government, corporate or municipal, credit quality, investment grade or high yield, duration, short-term, intermediate-term or long-term, or type, treasury, agency, or inflation protected. Specialty ETFs. These are ETFs that track alternative assets or strategies that may not fit into the traditional stock-bond framework. They include commodity ETFs, gold, oil or agriculture, currency ETFs, U.S. dollar, euro or yen, factor ETFs, momentum, quality or low volatility, and leveraged or inverse ETFs, which amplify or reverse the returns of an underlying index. Sustainable ETFs. These are ETFs that incorporate environmental, social and governance criteria into their investment process. They aim to generate positive social and environmental impact along with financial returns. They may exclude companies that engage in harmful activities, such as fossil fuels, tobacco or weapons, or include companies that contribute to positive outcomes, such as clean energy, healthcare, or education. To choose the right types of ETFs for your portfolio, you need to consider several factors such as expense ratio. This is the annual fee that an ETF charges its investors for managing the fund. It is expressed as a percentage of the fund's assets. The lower the expense ratio, the less it will eat into your returns. Tracking error. This is the difference between the performance of an ETF and its underlying index. It is caused by factors such as fees, trading costs, rebalancing frequency, and market conditions. The lower the tracking error, the more closely an ETF follows its index. Liquidity. This is the ease with which an ETF can be bought or sold on the market without affecting its price. It is measured by factors such as trading volume, bid-ask spread, and market depth. The higher the liquidity, the easier it is to trade an ETF at a fair price. Tax efficiency. This is the extent to which an ETF minimizes taxes for its investors by avoiding distributions of capital gains or dividends. It depends on factors such as fund structure, turnover rate, and holding period. The higher the tax efficiency, the less taxes you will pay on your returns. You can use online tools such as screeners and comparison tools to filter out ETFs based on these criteria and compare them side by side. The final step is to review and rebalance your portfolio periodically. This means checking if your portfolio is still aligned with your goals, time horizon, and risk tolerance, and making adjustments if necessary. You may need to rebalance your portfolio if your goals change. For example, if you decide to retire earlier or later than planned. Your time horizon changes. For example, if you are approaching a major life event such as buying a house or sending a child to college. Your risk tolerance changes. For example, if you experience a significant loss or gain in your portfolio that affects your emotions. Your asset mix drifts. For example, if one asset class performs better or worse than others and changes its weight in your portfolio. Rebalancing involves selling some of the assets that have increased in value and buying some of the assets that have decreased in value to restore your desired asset mix. This helps you maintain a consistent level of risk and return in your portfolio. Rebalancing can also involve adding new funds or removing old funds from your portfolio if they no longer meet your criteria or preferences. You should review and rebalance your portfolio at least once a year or whenever there is a significant change in any of the factors mentioned above. To summarize, to choose the best ETFs for your portfolio, identify your goals, gauge your risk tolerance, determine your asset mix, select types of ETFs, review and rebalance periodically. By following these steps, you can build a diversified portfolio that suits your situation and helps you achieve your financial goals.